So let's look at combining a first lien HELOC, the first lien HELOC strategy, which utilizes velocity banking, with a specially designed whole life insurance policy for infinite banking, and seeing how these two are mutually self supporting and exponentially increase the value of each. It is a 1 plus 1 equals 3 situation. So let's first start with just the whole life policy. Now, I'm not going into all the details here, but here you can see you're paying a $25,000 premium every year, and you can see how those stack up from year one to year four. By year four, we are cash flow positive, meaning when you pay that $25,000 premium into your whole life policy in year four, the cash value in your policy will grow by more than $25,000. But we can see cumulatively over the first 4 years, we have paid in $100,000 in premiums into our whole life policy. Of course, we have a large death benefit that gives us, a large permanent death benefit, not shown here, which is way more than $100,000. We have the long-term care protection, the creditor protection, all the great things that come with whole life insurance. But here, we're just going to be focused on the cost, that is the loss of liquidity. So over the first 4 years, cumulatively, we've paid in $100,000 in premiums, and we have $74,000 of cash value, liquid and available to us. As we move forward, we will have more cash value in the policy than the premiums we've paid in eventually. But this gives us the total loss of liquidity that we need to weather in the early years of this policy. This is the cost, if you will, of whole life insurance. Although I don't think of it that way, I think of it as a temporary loss of liquidity because you will get all of that back in spades, either when you die via the death benefit or alive as that cash value keeps growing. But for this policy, our total loss of liquidity over the entire length of the policy is in the first 4 years, $26,000. So that's how much we're going to be out of pocket temporarily to get this whole life policy started, to get our infinite banking system started. And that would be perfectly fine. If we understand infinite banking, we understand that cost is completely, totally worth it. But let's look at what happens when we layer in the first lien HELOC as well. So let's say you're also a homeowner, you have a $500,000 house, and on that house you have a $300,000 mortgage. Now what we're going to do is we're going to refinance that $300,000 mortgage into a first lien HELOC. So our mortgage goes away and is replaced with a $450,000 home equity line of credit with a $300,000 balance. And we're going to start running our income through that HELOC. So the mortgage balance will go down very quickly. But what that means is immediately we have $150,000 of liquidity available to us because we have a $450,000 home equity line of credit on our house, and we owe $300,000 on that line of credit to start with. So we have $150,000 of our home equity liquid and available to us on day one. So what that means is that $26,000 of liquidity we lose over the course of 4 years is more than made up for by the home equity line of credit. So on net between these two, we've actually gained a significant amount of liquidity. So this first lien HELOC makes the whole life policy much better because we don't lose any liquidity between the two. So the first lien HELOC more than replaces all the lost liquidity in the early years of the whole life policy, as you can see here. Now let's take a look at what this means from a cash flow perspective. So again, this is all about cash flow. We're going to be combining infinite and velocity banking to create our cash flow machine. And I'm keeping it simple and high level and conceptual for the purposes of this demonstration, because this can get really cool, but we're just going to keep it simple. So our income comes in to our first lien HELOC. That's the way this works. You are given a checking account that's automatically linked to your first lien HELOC. So now your income, instead of running through a dumb checking account that gives you no benefits, is now running through your first lien HELOC, running through the equity of your house. So all of your income is now working for you 24/7. It's reducing debt because it's paying down the HELOC by default. It's giving you liquidity because now 90% of the value of your home is liquid and available to you. It's creating velocity of money, meaning that all your dollars are working for you 24/7, and it's optimizing your cash flow. All your dollars are now doing multiple things for you. This is velocity banking. You could, as an example, there are lots of things you could do with this. You could, as an example, refinance some of your other debts into your first lien HELOC. If, as an example, you had other high interest debts or other debts that are taking away large amounts of your cash flow, you can refinance them into your first lien HELOC. And since you have no set monthly payment anymore, your cash flow is increased because you just eliminated your mortgage payment, which is for many people the largest monthly expense they have. Then from our checking account, which is linked to our first lien HELOC, we pay premiums because we do everything from that checking account. So now premiums go into our whole life policy. And so now we get all the benefits of whole life. So the same dollar has now gone through our first lien HELOC and into our whole life policy where we're building capital. We get death benefit protection, permanent death benefit protection. So it's also legacy. We get long term care protection, tax benefits, creditor protection. The whole life policy has guarantees associated with it. So the cash value always goes up. It's a self completing plan because that death benefit will be paid. So no matter what happens to you, your plan will complete to the tune of whatever that death benefit is, probably millions of dollars, whether you're alive or dead. And then when we want to use our money, we borrow against our whole life policy using the policy loan feature. So all our dollars keep working for us inside of the whole life policy while we're using it via a policy loan. So we are recycling our capital through this process. This is infinite banking. So with velocity banking plus infinite banking, we're getting our dollars working for us multiple times, right? The dollar is going through our first lien HELOC, then through our whole life policy, and then out into wherever we're going to spend it, wherever we're going to invest it, however we're going to use it via policy loans. So all of our money is now recycled for us. Every single dollar is working for us multiple times, and none of our money escapes our personal economy. So our dollars are working for us inside of our house in the first lien HELOC. That same dollar is working for us inside of our whole life policy, building capital, supporting the death benefit, and can be deployed via the policy loan feature as well. So by combining infinite banking and velocity banking, we are creating a cash flow machine whereby all of our dollars are optimized and every dollar can be used multiple times rather than just once. And all of our dollars keep getting recycled via policy loans rather than being thrown away when we spend them.